Ladies and gentlemen, my name's Tim Besley and I'm a member of the economics department here at the LSE, and I'm delighted to welcome you this evening to the Morishima lecture given by Thomas Piketty and supported by the Suntory Toyota International Centers for Economics and Related Disciplines. The lecture is named in honor of the late Professor Michio Morishima, who was a member of the economics department and the founder of Stickard. And Thomas was telling me on the way down that when he came to LSE, it was because he wanted to work with Michio Morishima, having read his work, which is very nice to hear. Michio was an economist of enormous range, whose interests combined the higher points of economic theory and the most practical interest in the world. And much like, I think, our speaker this evening. And I'm particularly delighted to welcome his wife, Mrs. Yoko Morishima, to the lecture this evening. Now, one of the first things that Michio did was to recruit Sir Tony Atkinson to lead Stickard in its early years. And this provides a direct link to this evening's lecture, since Tony is probably the major figure globally in the study of economic inequality, which is the topic of tonight's lecture. It's a great pleasure to welcome Thomas Piketty. Given the number of column inches devoted to Thomas in recent weeks, it's tempting to say he needs no introduction. But something that is rarely reported is how Thomas was already an influential economist before he was propelled to stardom by his best-selling book, Capital in the 21st Century. I knew Thomas well before he was famous and first met him shortly after he arrived at MIT, having studied at the LSE as part of our European doctoral program. At that time, Thomas was an economic theorist with particular interest in public economics, but for his work on the dynamics of inequality, which he established himself, this work was published in top mainstream economics journals, and he was awarded the Euro Jonsson Award last year, the top award given in Europe for a younger economist, and was awarded on the basis of his remarkable research. It is remarkable how Thomas' book has captured the popular imagination and created a platform for his creative research to influence the popular debate. Thomas has been described, as we know, as a rock star, but he's not the first rock star to come out of the LSE economics department, whose former students include, I'll remind you, Mick Jagger. Let's hope that Thomas is still enjoying the kind of adulation that Mick Jagger enjoys when he is also 70. Anyway, I'm now going to invite Thomas to the podium. He'll talk for about 45 minutes and then we'll take questions. Could I ask you all to put your mobile phones on silent? And there's a hashtag for this event for those who would like to tweet, which is LSE Capital. Thomas, you're very welcome back to the LSE.
Okay, thanks a lot, Tim, for this nice introduction. Yeah, I'm very, very glad to be back here at LSE. So as you can all see, these 2 years that I spent at LSE as a student were not enough to change my French accent, and I'm really sorry to be so bad at speaking your beautiful language, but anyway. So I am also bad with technique, but I'm sure there must be a way to get my slides up onto the screen. But I can also do without the slides. What do we have to?
Somebody around must be able to help us.
And there must be something to. Oh, this is where it is. Okay.
There you go.
Sorry, I must be very bad, but I still don't see where are my slides. Okay, that's very good. Okay, so this is what I'm going to be talking about. So this is. this presentation is going to be based on this book, Capital in the 21st Century. So, I should apologize also for having written such a long book. So, I'm sorry about that. I think this is, although it is a bit long, it is a readable book. And, I've really tried hard to write a readable story of income and wealth distribution. The reason why this is so long is also because in this book, I've tried to put together a lot of historical data on the dynamics of income and wealth distribution in over 20 countries since the 18th century. And, I should say very clearly that, this comes out of a very large international collective process of, accumulation of data and collection of historical data in income and wealth. And I could never have managed to collect all this data by myself. So I started working on the history of income and wealth inequality in France about 15 years ago. And then I was very fortunate to find, first of all, Tony Atkinson, who was my teacher at LSE in 91, 92, and who was the first reader of my work on income inequality in France, and who immediately extended this work to the case of Britain, has been working on many other countries, and together we've published two large volumes in 2007, 2010 at Oxford University Press, where we put together similar series on income inequality for over 20 countries. And this has involved many other researchers, Emmanuel Saez for the United States, Facundo Alvaredo for Argentina and Spain, Abhijit Banerjee for India, and Camille Landais, who is there somewhere, has worked on the case of France in much more detail than I did. Gabriel Zuckman has worked with me on the history of wealth to income ratio in the case of France, and he's going to start teaching at LSE next fall. Postel Vinet-Rosenthal have been collecting historical inheritance data with me. There's no way I can, refer to everybody, but, they are all referred to in the book and on the website, where you will find a lot more detailed information on the historical series. But, let me again make clear that this is primarily a book based on this historical data collection on income and wealth. So there is a part 4 of the book about the future and about possible conclusions that can be drawn for the future from this historical database. But let me be very clear about the fact that, I am better at analyzing the past than the future, and that, you can draw, we are in the domain of the social sciences. You can draw different conclusions from history, and, if you disagree with everything that's in part 4, this is fine with me, as long, you will find some interest in what's in part 1, 2, and 3. And, ultimately, the objective of the book is not to tell you with certainty, what's going to happen to the future of inequality and what should be done, but rather to give everybody more information so that they can write their own part 4. We still have too little data to be sure about anything. I think we have more data than we used to. We can, this can help maybe to have a more informed democratic debate, but, we know too little, and the objective of this book is simply to provide some of this historical material in an accessible form to everybody. Okay, so, in this presentation, I will present some of the results that are in the book, but, of course, there is no way I can present everything that's in the book. You can find all the graph and series for free on this address, but I'm afraid I cannot put the PDF file for the book online for free. Otherwise, my publisher, who is somewhere in the room, would probably disagree. So, let me tell you a bit more about the data sources that I've been putting together. So there's really two pieces of data, one about income and one about wealth. And largely what my book is doing is to try to shift the attention from income to wealth, but of course both are important. And wealth and capital is partly the result of accumulation out of income, so the two are of course related. So let me start with the income part of the database I'm going to be using. So this comes from the World Top Income Database. So initially, so the countries in red are the countries that are in the database. The countries in blue are about to enter the database. So what being in the database means is that we've collected the longest possible historical data on income. So this generally comes from the income tax. So the modern income tax was created in 1913 in the United States, in 1914 in France. 1909 in Britain, the income tax was made progressive, but there had been an income tax starting in the 1840s. There was an income tax that was created in India in 1922. There were progressive income tax, in Germany, in Sweden, in a number of Nordic countries, or in Japan starting around 1880, 1890. But by and large, this is between 1900 and 1920 that you start having an income tax, which also means that you start having data on income. Okay, so that's an important lesson, is that taxation is not only here to raise revenue. Taxation is also a way to produce legal categories and statistical categories and democratic transparency about income and wealth. When you don't have an income tax, many people don't even know what their income is. And when you don't have a corporate tax, sometimes you don't even have company accounts to define what corporate profits are. So it's not that the company accounts today are particularly transparent, but at least they are there. And when there was no corporate tax, you didn't have anything. So for income tax, the creation of income taxation means that we have data. Now, this data, this historical data was not used in a systematic way until recently, probably because this was too historical for economists and too economic for historians. So nobody really had been extending. So the first work that has been done along these lines was published in the 1950s by Kuznets, who was an American economist, a Ukrainian-born American economist, who first computed the first national accounts of the United States, the first GDP and national income series, and then, interestingly, moved to the direction of inequality measurement. So this was like the next step. After the national income in the US, he started using the federal income tax data that started existing in 1913, and he used it between 1913 and 1948 to compute the share of top 10% income earners in total US national income. And what he found was a decline in inequality, which you can see in this graph, with a big decline in the share of US income going to the top 10%, between the 1920s and the early 1950s. And you go from, 45, 50% of total income going to the top 10% income earners to 30, 35%. And all what we've been doing in this work, in a way, is to extend Kuznets' methodology to more countries and longer time periods. So instead, Kuznets had only one country over a 35-year period, whereas we have 20 countries over an entire century and sometimes a bit more. And as you can see with this picture for the US, of course, this changes quite a lot the view that we can have of the process. Kuznets came with a pretty optimistic view in the 50s and 60s, which was, the idea that you have a reduction in inequality in advanced stages of development, whereas, with the new part on the right-hand side of the graph that we've added with Emmanuel Saez. So this graph on the US comes from joint work with Emmanuel Saez. So we confirm what Kuznets had found for the first half of the century. We are using the same data, and he didn't have Excel, but he did the computations right, and we agree with him. But all what we add is that, in the second half, and in particular in the past 30 years, you have this huge increase in income inequality. So this gives a very different picture for the overall process. So, in the post-war period, in the 50s, 60s, 70s, there was this very optimistic belief that, inequality will naturally decline and then stabilize in advanced stages of development. And indeed, in the 50s, 60s, 70s, if you have a stable share going to the top, this means that everybody benefits from growth with the same growth rate. You have if you take the aggregate growth rate of the economy, you have the same growth rate for the top 10%, the bottom 90%, the bottom 50%, so you have balanced growth path. Now, in the past 30 years, you can see that this doesn't look like a balanced growth path because the share going to the top has increased from 35% to almost 50%. And in fact, the latest data point that we have put online with Emmanuel Saez for 2012 is even a little bit above 50%. It's about 51%. So the trend seems to keep going on. This is a pretty big trend. So, at some point, you have to take the number seriously. I think it would be a bit silly to deny, this very large rise in inequality. And, so some people seem to believe that, wherever it goes will be okay. But, at some point, you have to ask yourself, okay, this has gone from 35% to 50% in 30 years. Are we going to have 60% of total income for the top 10 in 2020, 70%? The numbers are so large that it's important to really understand what's going on. So I'm not going to talk too much about this in this lecture, but let me say, a few words. In the book, I report research, trying to analyze the reason for this big rise. So clearly, the inequality in access to education, in access to skills, and the evolution of the supply and demand of skill explain part of the rise in inequality in the United States over the past 30 years. But this is not sufficient, this reasoning in terms of education and skill is not sufficient to explain the huge rise at the very top. So in particular, you don't see that here, but a very big part of this rise comes really from the top 1% and the top 0.1%. And, it's not as if these people are a lot more educated than the 1% below them or the 2% below them. So, you really have a discontinuity at the very top that is very difficult to explain on the basis of supply and demand for skills. So with Emmanuel Saez, Stephanie Stancheva, we've been putting together a database at the company level where we really try to ask, okay, why is it that some companies pay their top managers $10 million instead of one? Is it useful? Is it bringing, better performance? What do we see in the data? And, frankly, we don't see much extra performance in the data, and this seems to have mostly to do with the growing ability of a number of top managers, to put the right people in the right compensation committee so that they get the right pay increase. And I think it would be very naive. In our standard textbook model, we tend to assume that when someone is paid 10 million instead of 1, it must be that his marginal product to the firm has grown from 1 to 10. I think this is an excessively naive view of how the labor market operates, at least at the very top end. It's very difficult to put numbers on individual marginal products in a large corporations, and there's a lot of imperfect information, to say the least. And of course, it's very tempting for top managers, to try to help, set their own pay in the most favorable way. And what we show, comparing different companies, different sectors, different countries, different time period with Saez and Stancheva, is that probably an important part of this explanation for this big rise has been, the huge decline in top income tax rate in the US, which has completely changed the incentives for top managers to, try to bargain upward their compensation package. Anyway, I'd be happy to answer questions about this process later on, but by and large, what I am doing in the book and what I'm going to do in the rest of the lecture is to try to shift the attention from this important issue of rising inequality and rising inequality of income and rising top managerial compensation to the issue of wealth accumulation and the distribution of wealth. So I'm going to show you another graph which looks a little bit like this one, but which in fact is very different and which has to do with the return of very large wealth to income ratio. Okay? So this is a graph about Europe, and you have very much the same evolution in Japan, but the evolution is less strong for the United States. So, it looks a bit the same as the previous one, with this sort of very big U-shaped curve, this very big decline after World War I, World War II, and then this increase in the recent decades. But in fact, this is not measuring at all the same thing. This is not the same economic process. So you have different processes going on at the same time. And this is not taking place in the same areas of the world. Largely, this is European and Japan phenomenon, whereas the rise of top incomes is mostly the US. Well, in Britain, you have a little bit of the two, so this is an interesting juncture, but this is, in Europe and Japan, this same US curve will be almost flat for the later part. You have an increase in the top income shares, but very moderate. For Britain, you will be in between continental Europe and the US. Whereas here you can see in Britain you have a general evolution that's very comparable to France. In Germany the levels are below, but the trend is the same. So what do we have on this graph? This is not, let me make very clear that this return of very large capital to income ratio as in principle is very different from a rise in inequality. So all what this is saying is that the total value of capital, and on this graph, this is private capital, private net wealth. So this is the total value of real estate assets, financial assets, minus financial liabilities, minus financial debt. Now, the value of everything that private households can own in the country, has increased tremendously since the 1950s and 60s as a fraction of national income. So this used to be, between 2 and 3 years of national income in the 1950s. This is now, up to 5, 6 years, 4, 5, 6 years of national income. So there is a clear rise. And as you can see, this looks like a sort of return to the previously very high wealth to income ratios that we had prior to World War I. Okay? Now, this per se does not necessarily imply a rise in inequality. It could be that everybody has an equal share in the capital stock. So in principle, this could go together with a perfectly egalitarian society. Now, in practice, the inequality of property, of assets, is always a lot more extreme than the inequality of labor income. So other things equal, this rise in the wealth to income ratio also tends to lead to a rise in total inequality, but this does not have to. Okay? Per se, there is nothing bad in the fact that we have a lot of capital relative to income. So anyway, in the rest of this presentation, I'm going to talk mostly about the first 2 points and not so much about the third point. So I'm going to be making 2 main points in the rest of this talk. The first point is going to be about what I call here, the return of a patrimonial or wealth-based society in Europe and Japan. And basically, the point is that wealth to income ratios seem to be returning to very high levels, particularly in low-growth countries. And Europe and Japan, a big difference with the United States is that they have a much lower population growth. So remember, population growth has been a very large part of total GDP growth historically. And Europe and Japan right now are having very low or even negative, in some cases, population growth. And the basic intuition is that in a slow-growth society, wealth accumulated in the past can naturally become extremely large. Okay? So, of course, at some point, the wealth accumulation, wealth to income ratio has to stop rising. So I'm not saying it's going to rise forever. It will stabilize at some point. It will stabilize somewhere. But this somewhere can be pretty high in a low-growth society. And, to some extent that we will have growth slowdown everywhere at some point, in particular for population growth, this can become relevant for the entire world. Now, the second point that I will be making will be more directly about the future of wealth inequality and wealth concentration. And so here, the main point I will make is that, okay, there are many determinants of wealth inequality. It really depends on the pattern of saving behavior across income and wealth group, and it's really very difficult to predict where it will go. But there's one important force that I would like to emphasize, is that other things equal, when you have a higher R minus G differential, where R is the net of tax rate of return to capital and G is the growth rate, then wealth inequality tends to converge to very high levels. So again, it's not going to converge to infinity, but it can converge to levels which can be possibly even higher than the extreme level we observed in the 19th century. Now, this doesn't have to happen necessarily. Nobody knows how far this will go. But, I guess one of the main points coming from this book is that, we need more democratic transparencies and we need adequate democratic and fiscal institutions so that we better know how this is evolving over time, and so that we can adapt our policies, in particular our tax rate, so as to democratize wealth and to have more diffusion of wealth. So the point is not to reduce the wealth to income ratio per se, but rather to try to make sure that the share going to the middle class and lower groups in society rises rather than shrink until an excessive point. Okay, so let me start with the first point, which is about the return of a wealth-based society. So, I'm not going to spend too much time about the technicalities. Just let me tell you that, in this book, I define capital and wealth in a very broad way, and that's including, everything we can own and that can be sold on the market, net of all debt. So this excludes human capital, except in societies where you can actually own other individuals as slaves. And I talk about this in the book, and I have results on these slides, which I will probably not have time to show you. Now, according to economic textbook, the ratio of capital to output or of capital to income is supposed to be a constant. But, you should be careful with textbook. Sometimes, when we don't know too much in economics about something, we just assume it's a constant. If you have only one data point, everything is a constant. But in fact, it is clear in the data we have that it's not a constant. In fact, we observe both in Europe and Japan a very large recovery of what I call the beta ratio, which is the ratio between capital and income, between the total value of what we own and 1 year of national income, from 200, 300% in the 1950s, 60s to 500, 600% today. Okay? So the key question is, are we heading back to the very high level observed in the past, or even more? How can we think about this? So first, let me show you the evolution. So this is the evolution of the private beta. So this is the ratio of private capital to national income in the top 8 developed economies in the world: the US, Japan, Germany, France, UK, Italy, Canada, Australia. So what you can see is two things. First of all, you can see that there's a lot of chaotic movement. The story of capital, as I show in my book, is always, a complicated, multidimensional story. So in particular, the story of real estate, the story of financial assets, the story of business assets, the story of the public debt are not the same. And when you aggregate everything, you are really aggregating very different processes, and you should always be aware of that. So in particular, when you want to explain some of the evolution, it's clear that a lot of the evolution that we have in this graph, have to do with short-term movement in asset prices. So look at Japan in 1990. Japan go from a wealth-to-income ratio of 500% in 1985 to 700% in 1990. Okay, even with a Japanese saving rate, you cannot accumulate wealth so fast, because in order to increase your wealth by 2 years of income in 4 years, you will need to save 50% per year, net of depreciation. Nobody does that. So here, this is clearly an example where what was happening in Japan at that time, of course, was a big rise in real estate prices and stock market prices. And then in the early 1990s, you can see that these asset prices are going down. So in the short run and medium run, you have lots of asset price movements, and I'm not going to tell you about real estate price in London or Paris. You've heard about that. So this is moving very fast, and this is clearly the dominant force. Now, in the longer run, there seems to be more than that going on, in the sense that you can see that every country was between 2 and 3 years of national income and of private wealth as measured in fraction of national income in 1970, and is between 4 and 7 years in 2010. Okay, so there's a clear pattern of evolution, and if you come with a model that tells you that it should be a constant over time, you have a hard time explaining this. Now, this rise of private capital relative to GDP, let me say very clearly that there's nothing bad per se, and actually it's good to have more wealth than to have only debt. And right now in Europe, and there are lots of people who feel that we have a lot of private debt, we have a lot of public debt. Well, okay, that's right, but we also have a lot more wealth than we've ever had for many decades. Okay, so in other words, actually, if you can compare the two, so on this graph, I compare the rise of private wealth with the decline of public wealth. So public wealth or public capital is defined in the same way as private capital or private wealth, which is the difference between the real estate assets, the financial assets, minus the financial debt of the government sector. So you can see that this can be negative. So for instance, in Italy, this is negative, which means that, according to the Bank of Italy balance sheet, even if the Italian government and regional and local government were to sell all the real estate, all the financial assets they have, they will still have some public debt left. They could not reimburse the entire public debt. But more generally, you can see that in every country, almost every country, net public capital has been declining over time. But you can also see that the rise in private capital has been much larger than the decline in public capital. So if you take the case of Italy, you probably, I'm not sure you can read the numbers below, but you will see that, in Italy, private capital rose from 240% to 680% of national income, while public capital dropped from plus 20 to minus 70%. So in other words, the rise in private capital has been 4 times bigger than the decline of private capital. So what this is saying is that it's not, you don't have it's not a transfer from public to private hands. Well, there's been a transfer, but it's only, the rise, for instance, of Italian private wealth, 1/4 of it corresponds to the fact that Italian households have bought the public bonds issued by the government of Italy and have sold some of the assets that were privatized by the government of Italy. Okay, so privatization of public assets, rise of public debt has been important. And in some countries, this has allowed a private household to get a lot richer than simply through saving. And certainly in Britain and in France, privatization, sometimes at very low prices, was a nice way to accumulate private wealth. There are some other countries in Russia where this has been an even more efficient way to accumulate private wealth. And apparently some of them have even come to London to benefit from this beautiful city. But as you can see, at the world level, it's more than a transfer from private to public, from public to private hands. The increase in private wealth has been a lot bigger than the decline in public wealth, which per se, is good news, because when we are always worried about the public debt, and we feel that we are going to leave more public debt to our children as a fraction of GDPs than we've ever left. Well, this is true, but we are also going to leave more private wealth as a fraction of GDPs that we've ever left for an entire century, and the increase in private wealth has been a lot bigger than the decline in public wealth. So again, that's important, and in Europe sometime, and in particular in my country, people feel that we are being owned by, the Emir of Qatar or the Bank of China or, whoever, or maybe the Mars planet. But, at the end of the day, not only, we in Europe own ourselves, but we actually have more financial assets in the rest of the world than the rest of the world in Europe. And, European countries are rich. Our governments are poor, which is a problem, but, European countries as such are rich, and, this is good news. Let me, I'm not going to show the much longer run evolution. Just let me give you a little bit of theory. I think simple mathematics can be useful. Sometimes economists, I think, use too complicated mathematics, but to explain sometimes very little fact or sometimes no fact at all, which is excessive. But I think a little bit of mathematics, if it helps you to think about a lot of facts, can be useful. So here is the very little bit of mathematics I want to give you. In the long run, if we forget about relative price effect, which we should never forget, because real estate prices, certainly don't move at the same speed at other prices, oil prices, other asset prices don't either. So, that's a very simplified view of the world. But still, if we forget about these relative asset prices and we think of a one good model where, we produce apples and capital is just a big pile of apples. And, don't ask me why we have a big pile of apples, but, that would be the simplest economic model. The simplest formula is that, in the long run beta, so which is the quantity of capital you accumulate, will be equal to S divided by G. So this is saying something very simple. If your saving rate, S, is twice as large, then in the long run, you will accumulate twice as much capital, which is not too surprising. What's more interesting is that if you have a lower growth rate, then in the long run, you accumulate a huge pile of capital. Take the extreme case where G is equal to 0. If you keep saving forever, you will accumulate an infinite pile of capital. So of course you're not going to do that. At some point you will stop saving because, if we all have, 100 floors for ourselves, the marginal value of having an extra apartment, will be zero, and people will stop saving much before that. But this tends, for given saving rate, this tends to push the beta toward high level. So typically, for a given saving rate of 10%, if your growth rate goes from 3 to 1.5, which is typically the difference between the US and Europe, if you have, zero population growth instead of 1%, 1.5% population growth, and if all what you have is the productivity growth rate of 1.5%, then you tend to accumulate much bigger quantity of capital, okay? So that's not enough to explain everything because, again, real estate prices matter a lot, energy prices matter a lot, but this gives you, a sense of, how to think about the total quantity of wealth we accumulate in the long run. Now, whether this is also going to push up the capital share in GDP, it's a complicated issue. I'd be happy to answer questions in what follows. What we've observed, in the recent past is a rise in the capital share. So this is the share of national income, the net of depreciation capital share in national income. And this has increased, so this is what I call the alpha in the book, and this has increased at the same time as the beta. Now, in the standard economic model, the simplest way to explain this would be what economists call an elasticity of substitution that's somewhat larger than 1, which will correspond to a situation where, this will correspond, imagine this corresponds to a situation where it's easier to substitute labor for capital. So, the extreme case will be, you all remember this announcement that was made by Amazon at the end of last year that they were going to replace delivery workers by drones. And, some people thought it was a joke, but in fact, apparently this was not a joke. Some other people say that, they are already treating their workers like drones, so maybe they should just have drones. But in any case, that will be, in the economic language, it will be sigma equal infinity. That will be an infinite elasticity of substitution. Now, in order to explain this, all what we need is an elasticity of substitution of 1.2, 1.3 instead of 1, which is the standard assumption in the so-called Cobb-Douglas production function. But, there's no reason to assume that the elasticity of substitution is exactly equal to 1. And this is only, this is really the only assumption where the decline in the return to capital would exactly compensate the rise in the quantity. Now, is this the right explanation for the rise in the capital share? I'm not saying that. I think there are many other explanations for the rise in the capital share. Certainly, the declining bargaining power of labor and unions and globalization has increased the bargaining power of capital, and this has probably been an even more important factor. Also, I think it's important when we think about the capital shares and capital accumulation to have a multi-sector model in mind. So, real estate and the rise of the rental value going to real estate has been a big part of the rise in the capital share. So if you only have a one-sector model, that may not be the best model to think of. So, in the future, it could be that drones and high labor capital substitution due to robots will become very important. But for the time being, real estate and the energy sector are much more important capital-intensive sectors than drones. So, at this stage, if we want to explain this, you should look more at the real estate sector and the energy sector. But, in the future, my main point here is that very small departures from our standard assumption, so, an elasticity of substitution just a little bit above 1, is enough to have a pretty big rise in the capital share as you accumulate more capital assets. Okay? So, for a long time, we've believed in economics that this ought to be stable. Capital income ratio is stable, capital share is stable, but, this doesn't have to be this way. Small departure, and even more so when you move to multi-sector model, can give you, large changes in this supposedly constant ratio. So let me move, and I guess I should accelerate because I can see from let me come to the issue of wealth inequality per se. Let me say very fast that the key question, the fact that we have a lot of wealth relative to income, again, is not bad per se. The problem is that in practice we have a level of concentration of wealth which is extremely large. So, the good news is that wealth inequality today is much less extreme than what it used to be. If you take a country, here I give typical numbers, the top 10% of the wealth distribution used to own 90% of aggregate wealth a century ago, and now they are closer to 60 or sometimes 70%. So this means that at least you have 20-30% of the national wealth that sort of used to belong to the top 10 that now belongs to what I call in the book a patrimonial middle class, which I define in the book as the middle 40% in society, which are not in the bottom 50% and not in the top 10. And this is an enormous change. The fact that we have a broad middle class that owns a significant share of national wealth, we should not, and of course at the top of that there's been a huge improvement in average living standards, average income, average wealth, but in addition there's been a diffusion of wealth which certainly did not prevent growth from happening. The kind of extreme concentration of wealth that we had in pre-World War I European societies, was not particularly useful for growth. So this has been a very important change. Now, the key question is, how did it happen and will it last? And, the reason why this is a concern is that in every country, you see in the recent period either a modest rise in inequality, or at least, this has stopped from declining. And in some countries, in the United States, I don't have the graph here, but some recent research by Saez and Zykman confirms that, there's been a rise in wealth inequality in the United States in recent decades, which is a lot higher than in France or in European countries, and so that the share going to the top 10% is now back to over 70%, 75%. So it's still less than in pre-World War I society, but the direction is not going in the right way, if you wish, or at least the middle class share in national wealth seems to be declining again. It's also important to see from this graph that there was no decline in wealth concentration until World War I. And, that's quite striking. In particular, my thinking about these issues have been influenced a lot by studying France around 1910, because, this was a time where people in France, thought that thanks to the great French Revolution, France had become a very egalitarian country, in particular as compared to Britain. This was the usual comparison. And the discourse of a big part of the Republican financial and political elites in France was to say, okay, we don't need progressive taxation. And in fact, progressive income taxation in France was created just to pay for the war in the summer of 1914, but there was a big resistance to the elite to create that, much more than in Britain in many ways. And largely this was because, the argument was, okay, we don't have an aristocracy anymore. We don't have a landed elite, so, we are already an equal country. We don't care about redistribution. Except that, in 1913, land did not matter anymore. It's only in Downton Abbey that land seems to matter in 1913. But, in the real world, land was less than 5% of UK national wealth in 1913, less than 5% in France. And, most of it was financial assets, real estate assets, business assets, international investment, much like today. And, the dynamics of wealth accumulation and wealth concentration in a republic like France and in a monarchy like Britain, in the end, do not look very different. So, I think, so what are these forces that determine the dynamics of wealth inequality over time? So this will be, this is the picture for Paris, where the concentration of wealth was particularly extreme. Prior to World War I, you have 70% of the wealth that's transmitted to the top 1%. And, that was not, apparently this was not really stopping. Nobody knows what would have happened without World War I. We are not in the domain of controlled experiment. We are not going to replay the 20th century again without World War I, the creation of the income tax, etc. But, apparently this was not declining naturally. And we have the same thing in the United Kingdom, in Sweden. So this is very, so the key finding is, there was no decline in wealth concentration prior to World War shock. So was the decline just due to the shocks? And apart from these shocks, what forces determine the long-run level of wealth concentration? So let me make now the last point of this lecture, with this, that, if you take any dynamic model of wealth accumulation, the steady state level of wealth concentration will be an increasing function of R minus G, where R is the net of tax rate of return and G is the growth rate. And for a very long time, R was a lot bigger than G simply because the growth rate was very small. And let me make clear that R bigger than G, does not imply that wealth inequality will go forever. It will simply imply that initial wealth inequalities will tend to get amplified to pretty large level. But this will not go to infinity because some families will decide to or will choose to dilapidate the wealth. Some families will have too many children. Some will have too few children. Some many things. Some will go bankrupt. Some will make huge returns. You always have shocks in the wealth process that imply some mobility. But for a given structure of such shocks, the steady state level of wealth inequality, if you do simple simulation, you will see that it's a very steeply rising function of this gap between R and G. Now, with growth slowdown in the future, rising tax competition to attract capital, there are reasons to believe that R minus G might rise in the future. Nobody can be sure about such an evolution and how far this will go. But potentially this can have very large consequences on the level of wealth inequality. So let me make two very quick points in the time I have left. The first point is that you should really some people when we say that R is naturally bigger than G, are surprised and even feel that this is not possible from a logical viewpoint. So let me make very clear that this is perfectly possible from a logical viewpoint, and in fact there is no economic model that predicts that R should be equal to G. In every economic model, R is different from G. It's usually higher. It could be smaller in some models. In history, certainly R bigger than G has been the norm. For a simple reason, probably the simplest way to think about this is to go back through time and, to compare. So, these are centuries over 2,000 years. So, of course, these are imperfect statistics. But, I think the orders of magnitudes are pretty clear. During most of human history, the growth rates were very small. So, until the Industrial Revolution, the growth rate were much less than 1% per year. So, of course, we don't know for sure the growth rate in the Middle Ages, but, we can be sure that they were very small, because otherwise, if they were just 0.5% per year during 1,000 years, this would imply that, the living standards at the time of Christ would be much, much below subsistence levels, and that the population at the time of Christ was less than 20 individuals, and, we have a lot of evidence that there were more people than that. So, we know for sure that the growth rate must have been less than 0.1, 0.2% per year during most of human history. And so R bigger than G was absolutely obvious in pre-industrial society. It's also obvious, in a way, when you read a novel by Jane Austen or, Balzac, it's pretty obvious that everybody knows that R is bigger than G. They don't say it this way. They don't say it this way, but, growth rates were obviously very close to zero. You could see that the society would reproduce itself every generation in an almost identical manner. There was a very slow rise in population, very slow rise in productivity, but this was all happening very slowly. And the rate of return was typically 4 to 5%. So, if you open any novel of Jane Austen, everybody knows that if you want an annual income of 1,000 pounds, you need a capital value of about 20,000 pounds, so that 5% of 20 is going to give you 1,000 pounds in annual income. And this is so obvious to everybody that, you don't even explain it, you don't even have to say R equals 5 or 4, because everybody knows it, because this has very deep consequences for people's life and what kind of living standards they have, what kind of, who they're going to marry with. This is so important, this is not just a technical economics issue. And in a way, R bigger than G during most of human history was the very foundation of society, because this is what allowed a group of owners of assets to live off their capital income and, to do something else in life than to care about their own survival. Now, one of the messages of my book is that the modern, the Industrial Revolution and modern industrial growth did not change this basic relationship as much as one might have expected. So in the sense that, with the Industrial Revolution, the growth rates have increased, but, they have increased to 1.5% per year. At the same time, the return to capital probably have increased a little bit, and, this is difficult to measure this notion in a very precise manner, but certainly what we know for sure is that the gap between R and G was not affected that much. And I think this is one of the key reasons why, the dynamics of wealth concentration in the 19th century led to a level of concentration of wealth at the eve of World War I, which at the end of the day was not very different from that in the 18th century. So the nature of assets, the nature of capital has changed completely from land to industrial and financial assets, but the level of concentration of wealth did not change that much. And in the future, so here I am just using the United Nations population projections, according to which the rate of growth of population will go to 0 in the 21st century. But, nobody knows. It could be that we are all going to have a lot of children, we are all going to make a lot of innovation, and, the growth rate are going to be 4 or 5% in the future. But I think we should not bet on that. And, we should, I think it will be more reasonable to have, another solution in case this does not happen. But, we should do everything we can to promote growth. But, there are reasons to believe that, in the 20th century, it's really an unusual set of circumstances which brought about very large growth rate, in particular due to very large population growth rate. More than half of this growth was due to population. And also the other unusual event is, very large shocks to capital owners. So this is the pre-tax, pre-shock rate of return. If you bring capital destruction during World War I, World War II, Great Depression, and taxation, inflation on private bondholders, then this is what you get. The after-tax, after-shock rate of return was actually very low during large part of the 20th century. And this is what, these very unusual circumstances that change completely the equilibrium between R and G. So, I'm not saying this is the only force that will play a role. Let me just conclude with this, very simple table that's, using statistics that, are, I should say, are even more uncertain than everything I have shown you so far, which comes from Forbes magazine rankings of billionaires. Okay? So, it's a bit sad. We live at a time where people buy a magazine to know about wealth, and, I would prefer if they could read, Eurostat or IMF report, but, they won't find the information. So we have to do with what we have, and what we have is that, so usually people take this list of billionaires and they say, okay, there are more billionaires every day, but, with a growing world economy, it's not too surprising that you have more billionaires today than 10 years ago. So here I do something that's just slightly more sophisticated, which is I take a fixed fraction of the world population, and I look at how the average wealth of this top group, at the top of the wealth ranking. So this starts in 1987 because this is when Forbes started publishing their ranking. I look at how fast they've been rising. Okay? So of course, these are not the same people over time. Okay, because some people are moving down, and you have some new billionaires, for instance, from emerging countries that are moving up. Okay? So you have some mobility of wealth, but whether you have mobility or not, if you were in an equilibrium of the world distribution of wealth, the average wealth of this group should be rising at the same speed as the average wealth for the entire world economy. Now, this is not what you have. As you can see, the top is rising 3 to 4 times faster than the average. Okay, so the top is rising at 6 to 7% per year in real terms, above inflation, whereas above this period, average wealth per adult has increased at 2.1%, average income at 1.4%. So it's important to note here that, world GDP growth has been 3.3%, but more than half of it is population growth. So, population growth is not over yet. It's going to decline in the future, but if you take, the very recent period, in particular due to aging, you have a lot of population growth in the world right now. So a big part of our feeling of growth in the world, 3.3% per year, and this is about what we have right now, in 2014, half of it, or in fact even more than half of it, comes from population. So the average income has been rising at only 1.4%, in spite of China, in spite of emerging countries. Average wealth has been rising a bit faster, 2%. That's because of the rise in the beta, in the wealth to income ratio that I have shown you earlier. So wealth is rising a bit faster than income, but a lot less fast than the top of the distribution. So what this suggests is that we live at a time where the top of the distribution is going up so much faster than the average. We have rising wealth concentration. It's very difficult to know, again, how far it will go. I have tried my best, to use other data, and let me conclude here because this might be relevant for LSE, who is certainly trying to build up its capital endowments. So this is data from university endowments in the United States. So what's good about this data is that it's a bit less passionate than the billionaire rankings, and also they are more transparent. They actually publish financial statements, so the portfolio, and you can compute returns. You don't have this information for the individual billionaire. Now, what you can see is that this kind of return, this is not what you will get, if you go to your bank with a 100,000 pounds portfolio. These days you're going to have a hard time. So getting that kind of return. So you can see, you have about 800 universities in the US. You can see that the returns are pretty high. So these are again the average real annual rate of return after deduction of inflation, after deduction of administrative costs and financial fees. So at the very top, you have rate of return up to 10%. At the bottom, you have 6%, which is already quite good. Now, at the top, so why do we have this? One explanation probably has to do with scales economies in portfolio management. So in the case of Harvard, they spend only 0.3% of their endowments in management fees, but because they have $30 billion, it's already $100 million to pay for wealth managers, which is a good sum, to pay for a group of wealth managers. And so if that's enough to get you a return of 10 instead of 8, or even 8 instead of 6, it's worth it. So, as long as this is Harvard and they are doing lots of useful things with the money and promoting science and education, we are all very happy. Although the poorer universities in the US may not be as happy, but but if it happens at the individual level as well, I think this is a clear example of what R bigger than G can mean for very large portfolio and financial endowments, and this is something we should all be concerned about, or at least we should study these dynamics of wealth more carefully. And at the end of the day, this is all what this research is trying to aim for. Let me stop there.
Well, thank you very much, Thomas. We have about half an hour for some questions. What I'm going to do is can someone put the lights up or dim the spotlights, because I'll be able to see who's putting their hand up. So I'm going to collect questions in batches of 3, and then we'll try and get around as many people. Can I ask you to be as brief as possible, and also to say who you are before asking your question? There are roving mics. It may take just a few seconds for them to get to you. Okay, so I'm going to start down here. I'll take one from each block in the first round downstairs, and I will come to you upstairs in a moment. Yeah. So, gentleman over there.
Thank you, Tom, for that wonderful lecture. I'm an ecological economist who wants to know how you think about the whole history of capital from ecological point of view, because you have mentioned something in your book about ecological stimulus. So I'm interested to hear from you.
Okay, I'm going to go to the middle block. Do I see a hand up there? Let's go to the back there. Just up to the back, just pass it in along the road. You see the hand up there?
Hi, Thomas. This is Harsh here. You mentioned you did a lot of research on income inequalities in different countries. During your research, which country do you think performed the best? And in terms of income inequality, and was there any policy or historical facts that you would accord to that low income inequality in that country?
Okay, and then finally I'll take one from the left, sort of half, come down halfway. There we are, just on that row there where you are.
Hi, my name's Tony. Margaret Thatcher in the 80s, she was presented with a question, a Prime Minister's question time, where she was lambasted for the increasing inequality during her administration. And in response, she said there was a dichotomy between growth and inequality, that to reduce inequality, you would suffer a reduction in growth, a reduction in efficiency, in effect. How would you respond to that?
Okay, so thanks for this very interesting question. So regarding, the ecological viewpoint and natural capital, so I address these issues at the end of the book. I think this is clearly the most serious challenge that we have for the future, and you can see that there's a contradiction in the fact that growth per se can be an equalizing force in the sense that it makes wealth accumulated in the past relatively less important. So, when you have high productivity growth or high population growth, that's a way to make wealth accumulated in the past less important. If we all have 10 children, you should not count too much on inherited wealth. But at the same time, there are limits to growth. So, world population has been multiplied by 10, from 600 million to 7 billion today over the past 3 centuries. Are we going to do that again in the next 2 centuries? Probably not, and maybe this is not desirable. There are reasons why growth at the level we've had, at least for population in the past, is not going to happen again. For per capita growth, it all depends on whether we find ways, of course, to produce clean energy sources. At this stage, we've not made this invention yet. So, this is another reason why growth might not continue. I think there's no reason to be excessively pessimistic. If we make the right investment right in time, this could, can very well continue to have at least this kind of 1.5%, 2%, between 1 and 2% productivity growth forever, assuming we invent clean energy sources. Now, the problem is that to do that, we need green investment and environmental investment in green technologies that we don't see today. And, I'm a bit concerned that, at the end of the day, our problem of financial transparencies and, fighting against tax havens and etc., are much simpler problems than global warming. So, if we are not able to solve these financial problems, so I think, one of the main reasons for solving these financial opacity problems is to try to devote our attention to more important and more challenging questions. First of all, is global warming. Let me turn to the question about the ideal country. I don't think there's any, there's a lot to learn from every country. I don't want to be rude with anyone. I think, when you look at the history of, the different income and wealth inequality in different countries, so of course, you find the Nordic countries, which are typically the country with the lowest level of income and wealth inequality. I guess here the main lesson that I emphasize in the book is, the main force that can push in the direction of a reduction in inequality is the diffusion of skills and knowledge, and which requires very inclusive social and educational institutions. So you want to find a way to get a very large group of the population to access the highest possible skills, and this is what explains the fact that the Nordic countries, despite some of recent shortcomings, still have, probably are closer to kind of equal opportunity ideals than anywhere else. But I think no country look, the United States have been very good at producing, for instance, very efficient top universities, but they're not been very good at getting, equal access to skills. So right now, I give a statistic in the book. Right now, the average income of the parents of Harvard undergrad students, corresponds to the average income of the top 2% of the US distribution of family income, which is a bit disturbing, because so that doesn't mean that there's nobody from below the top 2% that gets in, but this means something very precise, which is that there are sufficiently few people from below the top 2% that get in, and that the people within the top 2% are sufficiently high up in the top 2, that the overall average is as if the students were picked at random within the top 2%. So, I don't have the number for LSE. I'm sure it's a bit higher than that. For Sciences Po in Paris, which will be one of the most elitist institutions, that will correspond to the top 10%, which is a bit higher group, but still, it's as if, the students were picked at random. So, I think there's no country, has a perfect system. I'm not going to defend, the French university system is very badly organized, and I'm not going to say here that, this is the system that other countries should adopt. I think there's a lot to learn from the way the US university system and in some ways the British university system is organized, but no country has managed to reconcile, efficiency with equal opportunity in a way that's satisfactory. And, some countries in Europe, particularly Nordic countries and Germany, are very attached to free higher education and zero tuition fee. And, certainly if you let tuition fees rise and rise forever, that's not, that's probably not compatible with the kind of equal access to education that we would like to have. But there are other ways to make the system very unequal than tuition fee. And in the case of U.S. universities, there's a lot. There are interesting studies showing that the financial gift that the parents make to their former universities strangely tend to coincide with the time where they have children of the age of applying. So, there are other mechanisms. I think we need more transparency about, educational stratification. Like in France, you have sometimes a lot more public money per student, in the grand écoles and in the university system. So for the more advantaged students and the most disadvantaged students. So, there are many different ways to create inequality. And, each country has sometimes a lot of faith in its own educational model. That's certainly true in France, that's true in the US. I'm sure this is true in Britain. But sometimes this faith in our national model is not very well in line with actual evidence. And so, there's a lot to learn from every country. We primarily need more research and more transparency about, these important sources of inequality. Now, coming to Margaret Thatcher at the end, I think there's I have no problem with inequality per se. Some inequality up to a point can indeed be good for growth and for innovation. Now, the problem is that up above a certain point, when inequality gets too extreme, it's not useful anymore for growth, and it can, in fact, become even detrimental to growth, typically because it leads to a perpetuation of inequality over time across generations that prevents mobility from happening. So, we don't have mathematical formulas that determine where the tipping point is, but so we have historical evidence. So, for instance, as I mentioned earlier, one important historical lesson, I think, is that one important lesson of the 20th century is that we don't need 19th century wealth inequality to grow, in the 21st century. So, the kind of extreme concentration of wealth that we had prior to World War I, was not useful in any meaningful way. This was destroyed by World War I, World War II, and the policy that were enacted following these shocks. And, this did not prevent growth from happening in the post-war period. This does not prevent growth from happening today. So we don't need to return to, shrinking middle class and, all the wealth going to a tiny group as we had prior to World War I. So, we need to be careful about that. We cannot just believe that natural forces are going to keep inequality, where it should be, which is in the common interest.
Okay, I'm going to visit the upper tier here, but I'm a bit disadvantaged with the lights, but I can see a hand up on that side. So if somebody could, there's presumably someone with a mic there, come and pass it along.
Thank you.
Okay, yeah.
Shall I start with the first question?
Yeah.
I realize the focus of the book is not global inequality necessarily, but I'm interested in some of what you've written about particular Africa and foreign ownership of natural resources. Thank you.
Okay, let's go up there, sort of towards the back. Yeah, there we go.
Thank you. Thank you, Professor Piketty, for a very interesting book. I'm very curious how you reply to a criticism leveled by Nassim Taleb at your book. He has 2 points. On a factual level, measuring inequality using deciles is sort of a biased estimate because inequality, well, wealth distribution obeys a power law, and sometimes wealth is generated at the top. So that's the factual point. And the normative point would be that inequality shouldn't be the focus. What should be the focus is sort of bearing the risks of your own decision. And if you have a financial system in which you just have the benefits without bearing the risks, then this is actually the problem, not inequality.
Okay, and I'll take one from the middle block now. Yeah, in the middle there. Yeah, if you can see someone with their hand up there, yeah.
Excuse me.
Hi, Kieran Stopforth. My question is rising inequality, is that a problem or a thing that can actually be addressed? How much of an appetite do you think the public has for really putting in place the kind of changes that would be needed to address rising inequality?
Okay, so first of all, regarding Africa, I think the biggest losers of financial opacity are the poorest countries in the world, and particularly sub-Saharan African economies, where you have a lot of foreign ownership and at the same time a lot of capital flight, and in the end we care about this only when some African politician or son of politician is acquiring some real estate property in Paris and London, and then we find this really scandalous, and some wealthy people can come from Africa. But I think this is not really the way to address the problem. I think at the end of the day, the reason why we need more financial transparency and a more coordinated fight in tax haven, I think this is very important, not only for developed economies and for rich countries, but also, and even more importantly, for African countries and more generally for emerging countries, where it's very difficult to build confidence in the national tax system and in the national government, and team has worked a lot on constructing tax system. If you don't have some feeling that the top people are paying their share, so this is a concern certainly today in rich countries, that it's difficult in Europe to ask people to make the right effort if we feel that the largest companies or the largest wealth holders don't pay tax anywhere and manage to escape the tax system everywhere. But I think it's even more so in Africa, if there is the feeling that the highest income or wealth holders, and in particular people that are related to top politicians, don't pay what they should. So the issues of financial transparency and coordinated registry of cross-border financial assets that I talk about in the book, I think are even more important for poor and emerging countries than they are for developed ones. Regarding the sort of the different technical ways to measure wealth inequality, I think using percentile and decile is in fact, to me, is a lot more intuitive than using Gini coefficients. Nobody has ever seen a Gini coefficient, and, I think it's easier to think in terms of the top 1%, the top 10%, the bottom 50%. I think it's a much more intuitive way to represent inequality. Now, this is not at all contradictory with the fact that, wealth distribution, indeed, like income distribution, tend to follow power law, but, with very different exponent. The problem is, sometimes there's been a tendency in the history of economic thought, to sort of overestimate, the importance of these statistical regularities that you have Pareto or power laws. Because, in fact, the coefficients of this power law are not constant, even for a given year and countries, they are not exactly constant, but even more so over time, they are not constant at all. So at the end of the day, it's more, power laws are more a statistical technique to try to recover the full distribution from imperfect data, typically data coming from income or wealth brackets, than really something very deep about, the constancy of inequality over time and across society. And, Pareto had this view that, inequality, is stable forever, you cannot do anything about it. Well, the evidence that we have clearly shows that you have large changes in inequality. You have several possible futures, you have several possible levels of inequality. Europe used to be a lot more unequal place than the United States of America until World War I, and now this is the opposite. So, this is clear evidence that, we should not have deterministic view, mechanical view of inequality dynamics. And, I am much more interested in changes than in stability, because at the end of the day, the world sometimes is changing, much faster than what we initially imagined. And this brings me to the last question about policy change. I think I'm not very impressed by those who know in advance, what's going to happen and what's not going to happen. I think, 1 century ago, many people would have said that, the steeply progressive income tax or inheritance tax would never happen, and then suddenly in the 1920s, 30s, this became the, we had very steeply progressive tax system, and sometimes the governments don't do what they have planned to do in opposition. Sometimes they didn't really have a plan, so it's even easier, and things happen. Look, 5 years ago, everybody was saying that bank secrecy in Switzerland will be with us forever, that, Switzerland was too strong for the rest of the world. And then, which I thought was always ridiculous, but anyway, and then, you had sanctions from the US government on Swiss banks, and suddenly, Switzerland changed their bank law, and automatic transmission of information became possible. So, of course, it's a bit sad that European countries did not do anything by their own and had to wait for the US sanctions on Swiss banks to introduce some form of, increased transparency in Europe. But, I want to look at this episode in a more positive way, which is that, if you put the right sanctions, then you can get something. So, it's not, you cannot just ask politely to those who benefit from financial opacity to put an end to it. And, Gabriel Zuckman in a recent book has done some very interesting computation trying to compute, how much is the total benefit from a country like Switzerland of financial opacity, and he comes with a number that's equivalent to what Switzerland would lose from about roughly 25% tariff from Germany, France, and Italy. So, this is not the atomic bomb, but this is still a pretty big sanction, and maybe the true number is 20% or 30%, but this gives you an order of magnitude of, the benefits of financial opacity. If you don't outweigh them with sanctions that are comparable to those benefits, why would you change? So, these kind of sanctions are not useful per se. I think, globalization and open markets for goods, services, labor, capital are useful, and globalization is a positive sum game. But if you don't have proper rules that ensure that the benefits from globalization are distributed in a balanced manner, then I think there's a serious risk that more and more people turn against globalization. So yeah, with the proper sanctions and proper political coalition, I think there are ways to change this.
Okay, we'll go along the. So I have one right in the middle. I can see there. So I'm going to go right in the middle. Someone got the roving mic? This one here. Pass it along. So into the middle, please. There you go. Okay.
Hi. I just want to ask a rather personal question. Was there an observation that prompted your research in the first place? And after this book, what is it next for your research?
Okay, I'll go to the right now. Down just here, just when the mic comes back. Just right where you are.
Thank you very much. I'm a student from Pakistan. I would like to ask you, since this is in honor of Murashima Sensei, could you please elaborate a bit more on your aspect of wealth accumulation and taking the case of Japan as a country which after the Meiji Restoration started accumulating wealth, and you even showed the cycle. Could you please elaborate a bit more on wealth accumulation or endowed resources with countries? Thank you, such as US.
Okay, and I'll take a question from the left now, just down here.
Hello. Pete Comley, author and researcher about inflation. I'd like to know your view on how much you think the increasing inequality is actually related to the long-term inflation cycle, which peaks about every 200 or so years, last time in the end of the 18th century, beginning of the 19th century, and prior to that, at the end of the 16th, beginning of the 17th. Both of those times saw massive increases in the money supply, and that money then went to the rich. At the same time, the poor had increasing land prices, increasing rents, commodity prices went up, their wages went down, and you ended up with things like the French Revolution. So I'd just like to know, is that another explanation? And if it is, more concerningly, in both those times, governments were running massive deficits, and they tried to get that from the rich, and they failed because the rich were too powerful.
Okay, Thomas.
Okay, so let me start with, my personal motivation initially just came from the fact that, I realized that, there was all this historical data sitting there that had never been collected. So, initially I started as a theorist, as Tim earlier said, and, then I realized that, we were proving theorems about, and I was proving theorem about income distribution dynamics without really knowing, what facts needed to be explained, and that there was a lot of historical data on incomes that had never been used in a systematic manner. So, I started doing it for one country, I ended up with 30 countries, and then I moved from income to wealth. But, initially there was no plan, and there was no, I didn't know what I was going to find, and I just thought that it would be interesting to know a lot more about inequalities and do more than simply, theoretical speculation about this. In the future, I think I'm partly going to extend this to more countries, in particular emerging countries. So, I'm very interested in the dynamics of wealth inequality in China, which raises huge measurement issues right now, but which is a very important an issue and a growing concern in China and in a number of other emerging countries. And probably I also want to return to the study of the formation of political attitudes toward inequality and belief system about inequality, which is an issue I started working on a long time ago, which I sort of let aside during a long time because of all this historical data collection I've been doing. Japan, I think, Japan is an interesting case where you can accumulate a lot of capital almost without any, natural resources. So you have at least very little, natural resources certainly in terms of oil and gas and this kind of natural resources. And where the huge beta comes from the fact that, you have very large saving rate, and at the end of the period, you have very low population growth, in fact, even negative population growth. So, you accumulate a lot of assets per capita in the country. And, this is not bad per se, but this raises, different issues about, the policies, the tax system, which also brings me to, what you can do with the tax system and what you can do with the central bank and inflation. And so, inflation historically has been a very powerful mechanism to redistribute wealth. Now, the problem with inflation is that, it can go in every direction. Sometimes it can reduce inequality, it can increase inequality. And I guess the problem, I think in the recent years, we've been asking too much to central banks and creative monetary policy. So of course it's much easier to print money than to change the tax code. So, you can print billions of pounds or billions of euros or billions of dollars in one day. The problem is that sometimes, you don't really know what you do with the money. You put it somewhere, you lend it to someone, but, this is going to create a, huge bubble somewhere. So you have very low interest rate on public bonds, but then you can have huge rates of return on other assets, and for instance, in real estate bubbles. And, it's not clear that this goes always in the right direction. Sometimes you help people to get rich, which you wouldn't like to help. So at least, the tax system, it's more complicated. You need a parliament. You need people to vote on a tax base, a tax code. So that's a lot more complicated than printing money. But, at the end of the day, you have a better sense of what you're doing. So you can target, how much you ask to the different income and wealth group. You can have different tax rates for people who are, below 500,000 pounds, people who are between 500, 1 million, above 2 million. You can have a graduated tax schedule. And, I think in the recent years, we've been asking too much to creative monetary policy and too little to fiscal policy. But, it's not only, in the United States, in Britain, in the Eurozone, in Japan, pretty much everywhere. Central banks are useful institutions. Money creation is a very powerful tool. Sometimes, this is the only way, in a panic to avoid the collapse of a financial system. But in the long run, that's not going to solve our structural problem, typically inequality problem. Sometimes it can even go in the wrong direction. And most of the time we just don't know what we are doing.
Okay, thank you. Now, before I bring matters to a close, I've been asked to ask those of you seated in the stalls to leave by the front doors of the theatre, those who are seated in the circle to exit to the rear. And Thomas will be available in the theatre, the dress circle bar, to sign copies of his book. So if those of you who want to come back in and form an orderly queue will be able to get his signature on your copy of Capital. But before we finish completely, I'd like to offer a vote of thanks to Thomas for a wonderful lecture, really demonstrating the